All right, today we're cracking open a true classic. We're not just reading an old shareholder letter, we're going to tear apart Warren Buffett's 1994 masterpiece for Berkshire Hathaway. Why? Because the core principles in here are just as powerful today as they were then. Let's get into it. This one line, it sets the tone for everything that follows. Buffett's basically saying, look, we're huge now, so the crazy returns of the past are, well, in the past. But the underlying philosophy, that doesn't change. So in this breakdown, we're going to unpack the three big ideas he lays out: how to understand what a business is really worth, how to allocate capital like a genius, and maybe the hardest part, how to master your own mind.
So let's start with the absolute foundation. The world changes, markets go nuts, but Buffett argues that the basic formula for winning in this game is stunningly simple and it never ever gets old.
Okay, this looks pretty straightforward, right? Buy good companies at fair prices with good people. Duh. But here's the kicker, the part Buffett really hammers home. Knowing the formula is easy. The insanely hard part is actually sticking to it, especially when you've got that fat wallet he mentioned. When you're sitting on a pile of cash, the temptation to just do something is immense, and that's when you start lowering your standards. And that idea of buying at sensible prices leads us right to the first core principle. Because to know what a sensible price is, you first have to figure out what a business is truly worth. And that, my friends, means understanding the huge, often massive gap between what the accounting books say and what the economic reality is. Now, this contrast is so crucial. Book value, that's looking in the rearview mirror. It's just an accountant's tally of what's been spent in the past. It's clean, it's easy, but it can be really misleading. Intrinsic value, on the other hand, is all about the future. It's about how much cash you can pull out of the business for the rest of its life. Buffett even points out that with his original Berkshire textile mills, the book value was a lie. It wildly overstated the real value of the business. So there's the textbook definition right from the letter. And look, Buffett is the first one to admit that this number is fuzzy. It's an estimate. You can't calculate it to 3 decimal places. But, and this is the key, he argues it is the only logical way to judge an investment. Period. It forces you to think like an owner, not just a trader. Okay, enough with the theory. To really drive this point home, Buffett gives us a perfect real-world case study of this whole idea in action, the purchase of Scott Fetzer. Just look at these numbers. It tells the whole story. Check out the earnings column. It basically doubles over this period, from about 40 million to almost 80 million bucks, a cash machine. Now, look at the ending book value. It actually goes down. Why? Because Scott Fetzer was so profitable, it was sending all its extra cash back to Omaha. If you were just looking at the accounting, you would have totally missed the incredible economic engine humming away here. And here's the payoff, the punchline. Because they managed for intrinsic value and cash generation, this collection of pretty normal businesses produced a return on equity so ridiculously high, it would have been number one on the Fortune 500 list that year. That's what happens when you see past the books. Okay, so once you've got a handle on intrinsic value, that flows right into Buffett's second principle. This is what separates the good from the truly great CEOs, masterful capital allocation. I mean, knowing what something's worth is one thing, but using your capital to make it worth even more over time, that's the whole game. He uses this classic Gretzky line to explain it perfectly. He could not care less about deals that give a little pop to next quarter's earnings per share if they actually destroy value in the long run. He's always thinking about the future earning power of Berkshire, not some short-term metric. And man, he is just ruthless in his critique of the typical M&A world. He paints this picture where in most big deals, everyone wins. The sellers make a fortune, the investment bankers get their giant fees, the acquiring CEO gets a bigger empire and a bigger paycheck. The only loser? The acquirer's shareholders, the very people paying for the party. Why? Because they so often give up way more in value than they get back. And this anecdote he shares, it's just perfect. It gets to the heart of why this happens. So often, it's not about logic or spreadsheets. It's about biology. It's ego. It's what he calls the institutional imperative. It's corporate peer pressure, plain and simple. And it's an absolute killer of shareholder value. So, you can figure out what a business is worth, and you understand the discipline of capital allocation. That brings us to the final, and let's be honest, the hardest part of the equation, mastering the battle inside your own head. Because all the brilliant analysis in the world means nothing if your own psychology torpedoes it.
Buffett's advice here is pretty blunt. Just tune out the noise, all of it. The political forecasts, the economic predictions. He reels off this list of huge world-changing events: war, oil shocks, a 500-point market crash. And his point is that none of it, not one thing, changed the basic principles of buying a good business at a fair price. Trying to guess that stuff is a fool's errand.
But here is the tactical genius behind his thinking. It's not just about ignoring the fear, it's about actively using it. This quote says it all. Widespread panic in the market? For a fundamental investor, that's not a crisis. That's an opportunity. That's when great businesses go on sale, because everyone else is freaking out. Now, just as you're nodding along, thinking, yeah, I get it, Buffett does something brilliant. He gives us a massive dose of humility. He immediately cops to his own fallibility, introducing what he calls his big, unforced error, the absolute disaster of an investment he made in USAir.
And he just lays it bare with brutal honesty. He calls it sloppy analysis. He admits he completely missed the most important factor. The airline industry is a commodity business. In that kind of business, cost is everything. USAir was a high-cost producer, and that was basically a death sentence. This is why having that mental fortitude is so important, so you can admit you screwed up, analyze why, and not make the same mistake twice. Yeah, the numbers don't lie. They ended up writing down the investment to just 25 cents on the dollar. It's just a raw, powerful reminder that even the absolute best in the world can get it spectacularly wrong. It's why discipline and humility are non-negotiable. So, how do all these pieces, value, capital allocation, psychology, come together to create a lasting advantage? Well, Buffett wraps it all up with what might be his most famous analogy ever, one that perfectly captures the entire Berkshire philosophy.
This is it. This is the whole thing in a nutshell, explained through baseball legend Ted Williams. See, investing isn't a game where you get called out on strikes. You can stand at the plate and watch thousands of pitches go by, overvalued stocks, complicated industries, speculative bubbles, and it costs you absolutely nothing. The entire game is having the discipline to wait for that one perfect pitch right in your happy zone, and then, and only then, do you swing with everything you've got. And at the end of the day, that's the question this letter really leaves you with. It's one thing to know your circle of competence, to know what your happy zone is. But in a market that is constantly screaming at you to do something, anything, right now, do you have the psychological strength to just stand there and wait for your pitch?